Trading strategies for impending volatile markets. I am Don Kaufman. I will be your host and trader tonight. This is a TheoTrade presentation. Few things. Risk disclosure, we're not financial advisors, nor are we a broker-dealer. We put that up there because I spent, a number of years in the brokerage business. Copyright disclaimer, this is ours. This is not yours. I also encourage you, if you ever have questions, you can email us. You can call us, but I'll actually answer. I typically don't answer the phone, but I'll definitely answer your email, support@theotrade.com. We actually use a common inbox. A little bit about me. Again, my name is Don Kaufman, the co-founder and lead instructor here at TheoTrade. Well, I've been around the business for just around 20 years. I started trading in the late 90s in Chicago. A short time thereafter, I was invited to a startup brokerage firm that was called thinkorswim. If you're not familiar with what a thinkorswim was, well, back in the, again, 2001 is when the firm kind of launched. It grew in popularity. In 2007, we took the company public. By 2009, we were acquired by none other than TD Ameritrade. So initially, I ran and built the education division of thinkorswim, and then I went on to run education for what was at the time 7 million clients of TD Ameritrade. So it's a little background on me. The entire time, and throughout that, I've always traded for, of course, personal accounts. Just because you're in the brokerage business doesn't mean you can't trade. Of course, we traded. A little bit of the CNBC tour over the years. I've done a number. This is obviously one of the more memorable ones because if you're going to be pitted against somebody, you want to be pitted against, Mr. Wonderful here. I was the short, he was the long. Turned out pretty good. A little bit about TheoTrade. We specialize in education for stocks, options, and futures. All of us on the TheoTrade team have a minimum of 15 years of experience. A few of us actually have a couple of decades. I'm 2 decades down, but, I'll show you this in just a minute. And we're here to help you mitigate risks. In fact, tonight, we're going to be talking a bit, obviously, about trading, but we'll talk a little bit about risk mitigation in the midst of some more volatility in this marketplace. Another aspect I always like to bring up front, this is TheoTrade, meaning that TheoTrade is not just myself, Don Kaufman. We have Jeff Bierman, who I worked with for a number of years at both thinkorswim and TD Ameritrade. If you've ever been on the thinkorswim platform, Jeff Bierman actually determined many of the charts and studies that went into that trading application. In fact, Jeff and I also put together a lot of scans for thinkorswim. Then we have Matt Williamson. Matt's our market neutral premium selling strategist. Corey Rosenblum, senior strategist and swing trader. I kind of call Corey the resident swing trader. Brandon Chapman. Brandon also worked at TD Ameritrade. In fact, Brandon wrote most of the education course materials. There was a course that Brandon wrote, just $24,000 course for 18 months. And now, not only do we have him on staff, but Brandon helps put together many of our materials here at TheoTrade. His macroeconomics, technicals, fundamentals. Steve Slim Miller, 43-year veteran stock options and futures traders. Slim actually started on the floor at the Chicago Board Options Exchange in 1973. For those of you that know this, the SIBO was only founded in 1973, and that's when he started. Last but definitely not least, we have an intraday strategist. That, of course, would be Tony Rago. So I just wanted to give you a quick introduction. We are now up to seven full-time instructors here at TheoTrade, all contributing throughout the course of the day, all contributing to new classes, multiple classes now per month. Tonight's presentation: learn why rising interest rates will continue to spur an increase in market volatility, how to determine what strategies and trade logic you will need to thrive in a more volatile market environment, discover why options premium selling, we're going to talk about that in a bit more depth, will once again become the go-to strategy. For those of you, if you've been around the block a little bit, a lot of people kind of start with options premium selling. If you've sold option premium in the last 5 years, I'm going to guess that you've been run over considerable number of times. Well, we're actually going to talk about options premium selling, as it's starting to come back again into like the go-to strategy. It's kind of in vogue, how to find the highest probability trades while learning to cut down your overall market risk. And that's a really big portion of this. Just knowing how to sell an option. And remember this, it's not going to mean anything. Anybody can go out and sell an option. It doesn't necessarily determine that you're going to make money. All right, with that, let's get started. Okay, monkeys throwing darts. So I love this slide right now. I really do. I've actually been using this slide in a lot of the presentations I do. So if you've seen this one before, I'm sorry, but I love it. Because if you think about the marketplace as a whole in the last 10 years, a monkey that could throw darts literally would have made money. Okay, there was a monkey that was way back in like the 1990s, and they pitted the monkey against the biggest mutual fund managers, and the monkey won. The monkey's name was Raven the Chimp, and I've never forgotten that because it was right at the beginning of my career, and I'm like, really, you're getting outperformed by Raven the Chimp. Anyway, with that, but moving forward, you're going to need a definitive skill set. I hope you guys recognize that you're not going to be able to be that monkey throwing a dart anymore. And we intend tonight is to introduce you to those skills and, more importantly, the criteria needed to thrive in markets. So I'll briefly mention a little bit about the Fed, and I'll briefly mention a little bit about the increase of interest rates. But let me get this, down pat over here. So all good, what I call Fed things, must come to an end. And what I'm saying is, starting in 2018, the Federal Reserve is effectively departing the marketplace and will commence contracting the $4.5 trillion balance sheet. As the Fed capital declines, interest rates, you kind of think they're going to increase, but it's not exactly what you think. And I'll come to that in a moment. Investors and traders are going to be forced to unwind positions, in countless marketplaces. Why? Well, because interest rates go up and the cost of them carrying positions is extraordinarily expensive. In effect, as the Fed pulls away the punch bowl, capital markets are going to become increasingly volatile. So this is also another slide that I've used a considerable number of times. So this was kind of a year ago. That's right there is a year ago. And here is where we currently are. So the contraction of this balance sheet has already kind of come into full swing. It's the contraction of the balance sheet, to me, that causes the issues. All right, this is just capital being sucked out like a giant vacuum out of the markets. Stop thinking about the next Fed meeting, what is Jerome Powell going to do? Jerome Powell may do nothing. Doesn't really matter because they're going to continue to contract, though, this balance sheet. They got to get the balance sheet down. And I can't stress this enough. They really want to get it down to about $2.5 trillion before the U.S. would be to enter into, of course, another recession, which, listen, I know that's like a horrible word. I don't necessarily think we're headed into a recession right now, but recessions do happen. It has been, a decade since the previous one, and they want to get this balance sheet, and they got to get this balance sheet down. Why? Otherwise, it completely disarms them. If the Fed is caught in a recession, with the balance sheet up here, what are they going to do? Oh, let's just keep juicing it. Eventually that runs out. Now, here's another interesting one that maybe you haven't seen, but debt versus the S&Ps, it's an absolute perfect correlation. Just figured I'd throw that one up there. That's the S&P, versus outstanding total U.S. debt, which again is fairly alarming to say the least, because there's almost a one-for-one relationship on that one. Next, the writing's on the wall. Literally. I mean, the Fed's going to continue to raise rates, but really, they're going to contract the balance sheet. Central banks around the world have already started to follow suit, right? Mario Draghi, they're cutting it off, right? So moving forward, you need to be fully aware the Fed, they don't have your back anymore. It's time to start to get back to selling options premium as increases in volatility are forthcoming. So let's get into some more detail. Other than the writings on the wall, let's not state the obvious, I ripped through those first few slides fast, What do you know? Listen, you know that the balance sheet is being contracted, right? You kind of know that interest rates have gone up a little bit. You got it. But are you aware that higher rates, and a contraction of the balance sheet is going to produce volatility? In a higher interest rate environment, the following are going to become relevant. The cost to finance positions for major trading firms increases substantially. Why? Big trading firms use short duration paper. That basically means this. They use like 1 year borrowing costs, right? Or 2-year borrowing costs or 3-year borrowing costs. You have to recognize that right now in the markets, okay, right now in the markets, we've actually had an inversion of the yield curve. That basically means like to borrow money for 3 years, to borrow money for 5 years, to borrow money for 10 years, okay, is all right around the same cost. So what does it do to major trading firms? Ooh, it starts to hurt them. So what they have to do is they have to contract capital, okay, from the markets. They have to actually shift some strategies out there too, which doesn't exactly make the world an easy place for some of the big trading firms. Stock buybacks, though, will also become less viable as firms can no longer borrow capital at rock bottom rates in order to purchase their own stock. By the way, I've really been critical in the last 2 weeks of stock buybacks because the buybacks, they don't make sense right now. Why? I mean, look, this year as a whole, and I'll just throw a quick statistic out to you, okay? This year, according to JP Morgan, there's going to be, oh, that was a giant dot. That was awesome. Boom, boom, boom. Sorry, I'll fix my pen. Okay, where's the fun? Where's the fun in that? All right, this pen likes to just change on its own once in a while. So this year, JP Morgan Asset Management says it's going to be a record. It's a $1 trillion stock buyback year. Go check it out, okay? So $1 trillion stock buyback year. Do you really think that next year is going to be larger than $1 trillion? Could you foresee that right now? Can you foresee right now that they're going to spend more than $1 trillion in stock buybacks? I have a tough time believing that. Why? Because the rates have actually gone up. But here's what you have to remember. They're doing $1 trillion of stock buybacks this year. Apple, unbelievable. And the marketplace is still going down. Okay? I want you to remember that. And the marketplace is still going down. The largest stock buyback in the history of markets, and the market's going down. So eventually, what are they going to do? They're going to throw in the proverbial towel. Fixed income will once again become what? Appetizing. Fixed income can actually become appetizing. Bonds. Why? Because you get paid like 4% on capital. That looks pretty damn good, doesn't it? Compared to like the last decade, getting 4%, you're like, oh yeah, I'm going to get me one of those CDs. I just saw a CD offering at 4% the other day. So what do you think that does? Takes money out of the capital markets, takes money out of equities. People go, you know what? I am done with this volatility. Forget that. And they're actually going to go run. And what are they going to do? They're going to run over to CDs. They're going to run into fixed income. Consumer debt becomes a burden. Why? Rates increase, so do defaults. That's an interesting one. If you haven't actually gotten one of these, if you owe money on a credit card, you've probably already gotten something that says like, hey, your interest rate's going to go up on that credit card. Don't blame us. Blame the Fed. Housing valuations slow or decrease. The ability to borrow against equity within the home stalls. Okay. Car sales. Well, car sales are going to falter. 0% loans. They're totally drying up right now. Discounts are getting hard to find as automakers preserve profits. Now, you want some evidence of this? Let's do it. First of all, fixed income once again becomes appetizing. This is the TNX. It's the 10-year. Look, the interest rates went up. But you know what? It's not even the 10-year that I'm so much interested in. Okay, I threw the 10-year up here because it was kind of a fun chart. Really, where it's becoming interesting, though, is more like the 3-year. Or again, the 5-year. Those are becoming really interesting because you can tie your capital up for 3-year and you can make almost as much as if you tied it up for 10 years. Okay, and again, that's what they call the flattening or the inversion of the yield curve. Next, okay, consumer debt becomes a burden. Why? As rates increase, so do defaults. This is just a quick chart of MasterCard. Why did I throw MasterCard up here? Because I just wanted to show you MasterCard went up the moment the interest rates started getting a little crazy. Wow, look at the volatility inside of MasterCard. It's actually the largest volatility we've seen in this underlying in years. Okay, if you don't like MasterCard, maybe you like Visa. The exact same thing. Now, the interesting thing about Visa and MasterCard, they really haven't dropped all that substantially yet. They're just throwing off some bouts of volatility. I mean, come on, they've come off from 150 here to maybe 135, but on a percentage basis, it's negligible thus far. Come on, it's a 10% drop. These things could still be, again, poised for substantial movement to the downside. Then let's actually look at the home builders. How are the home builders impacted this? Housing valuations slower decrease. The ability to borrow against equity within the home totally stalls out. Now, the XHB has been absolutely decimated. It's down over 20% on a year-to-date basis. If you don't like that one, just go look at something like Toll Brothers, because I really wanted to bring this up. Toll Brothers, which is a specific builder. I'm really familiar with it because they're huge right here in Scottsdale, Arizona. They're down 34% year to date. It's tough to believe that we have a wonderful economy when one of the premier builders is down that severe. Continuing on, Home Depot. If you haven't looked at Home Depot lately, it is getting, well, hammered. This is actually Home Depot coming off the 210, 215 marker all the way down to 170. Again, housing valuation slow. Okay, people are not going to go out there, okay, to do what? Borrow home equity. And again, things like Home Depot and Lowe's. I do happen to have short positions inside Lowe's. I was short inside, specifically inside of the XHB. I've now closed that position for a very large profit. I am continuing to hold position in Lowe's. Ford, okay? Car sales are going to falter. 0% loans are drying up. Well, this one is pretty much self-explanatory. It's 13 all the way down to 8 on a percentage basis, getting decimated. GM, if you're not comfortable looking at Ford, maybe look at GM. Also getting whacked fairly hard from very recent highs. Again, the writing is on the wall. It's whether people are actually listening to that. So you got to learn to not flush your money. You need to be smarter than the competition. You need to learn a couple of skills, obviously, that can profit from more volatile markets. Now, today, you're just going to discover one, okay, non-directional trade logic. Now, what I'm about to talk about is a strategy that a lot of you may be familiar with, okay? But what people are not familiar with is how to take this strategy, okay, employ it in the correct fashion, okay, and not take on drastic risk. So again, if you're like, oh, I know this strategy. Some of you guys know this strategy, some of you don't. Hang in there with me. Because the key to a strategy, listen, you can Google any options strategy, and 5,000 different pages are going to show up in Google for that particular strategy. Very few, though, are going to tell you, okay, in order to profit from it throughout volatility without taking upon drastic risks. First, again, I got to go through some of the basics over here. Learning to sell options. Because many people have kind of heard through the grapevine that selling options is, it's the way to make money. Okay? But if you've experimented with selling options, you know full well there is definitely some big risk involved. Today's session, I'm going to separate the myths from the real risks, the fact from the fiction in selling options premium. And I'm going to be very, very forthright right now with you. Selling premium has not been all that good since about 2012. Now, I want to throw that up there again for your consumption. Selling premium. What happened in 2012? Volatility, or we can call it the VIX, dropped, and it dropped substantially. 2012, 2013, 2014, there was a small bout in 2014 that was actually pretty good to sell some premium. 2015, brutal. Now, 2016, okay, there was a 10-week period in 2016 that made my entire year, okay? But just in the last, okay, few months, here we are in 2018, towards the end of it, and premium selling all of a sudden is coming back into style. Okay, so if people have been shoving premium selling down your throat in the last couple of years, you've ended up in some deep trouble. And I'm actually going to show you exactly, okay, where that deep trouble kind of lies. So with that, let's get to it. All right, don't panic. You can do it. You may not know anything about options. That's okay for today's session. All I want you guys to be able to do, if you're brand new, is anybody here brand new, has no idea what an option even is? Come on, there's almost 1,000 people on right now. When I ask that, like, nobody ever wants to admit anything, all right? Look, if you're brand new, you have no idea what an option even is. It's fine, okay? Grab big concepts, big, all right? How many people actually know a little bit about premium selling? Huh? Anybody? Anybody? By the way, if you're watching this on a recorded thing, yell! Just yell at the screen. It's okay. You're like yelling at your iPad over there. Everybody thinks you're crazy anyway. It's good. So, all right, for starters, again, Big concepts regarding profitability and risk. Let's dive right in. Probability and profitability. So trading is really based on probability. All right, it's based on probability. Like, what does that mean? Well, you and I can create trades all day long with a 90% probability of success and still lose money. One funny thing is that when I look around at other websites and so forth, and there'll be sites and they'll be like, check out my track record. Check out my track record. I'm right 90% of the time. I should actually put up the slide of the monkey, because the monkey can be right 90% of the time, right? Just go out and sell way out of the money options. Question is, what's going to happen to you the other 10% of the time? Anybody? What's going to happen to the other 10% of the time? You're going to get killed, and it's going to be in a big way. The problem, though, when you're right 90% of the time, okay, you lose fear. You think you're actually like, I'm going to be the next Warren Buffett. I haven't had a losing trade. And the marketplace is really smart. The marketplace knows how to lure you in. It knows. They're like, come on. And it lets you make money like 20 or 30 times when you do a 90% trade. And then one day it sneaks up behind you and it like jumps on top of you and starts ripping your head off. It's awesome. Probability alone, okay, doesn't make you profitable. If anybody ever said, I'm right 90% of the time, that means nothing. You better remember that, okay? That comes from 15 years in the brokerage industry. I always had, these people like, oh, yeah, I run a hedge fund. We're right 90% of the time. And we're like, we don't even want your business here. We don't want your business, okay? Why? Because we know that hedge fund eventually blows up. You got to think about that stuff. Markets are always going to be a trade-off. Markets are always a series of trade-offs. Higher probability has higher risk. You can be right 90% of the time and still lose money. So where can you find some edge? I mean, that's what people are here for, right? All right, great. Because what we're about to show you, very important. First of all, premium selling logic. Let's go back to some of the basics of premium selling logic. Because what I fear right now, okay, is that many people are familiar with the logic of premium selling, okay, but your skills are not really in tune, because first of all, there hasn't been that many good premium selling opportunities in recent years, unless of course you're just out there, kind of willy-nilly selling once in a while. But for those of you that really want to make a living, I'm talking about making a living on selling premium. It's been rough. It's been really rough. I mean, listen, I grew up as a premium seller. I literally grew up in this industry as a premium seller. And then all of a sudden, the last like 5 years, okay, I blame the Fed. They're like, he squashed all the premium out of the market. So here's a stock, and the stock's trading at 100. By the way, I always call every example I do, it's not just a stock, it's stock. Okay, so we'll call it stock. Oh, my pen changed again. It's killing me. So this is a stock called stock. Now, what premium selling is, the stock's trading at 100. Now, I don't own the stock. I have nothing to do with the stock. I'm not long the stock. I'm not short the stock. And there's options on this. Okay? We're going to call this a 110 call. Now, what is a 110 call? Let's say a 110 call is trading for $1. Okay? It's trading for exactly $1. What's a 110 call give you the right to do? Well, if you buy it, you have the right to buy stock at what? Okay, if I turn around and buy a 110 call, okay, I pay $1. Then I have the right to buy the stock at 110. But the stock right now is where? At 100. If I bought the 110 call for $1 for the next, I don't know, let's call this 2 months. 2 months. Okay, so if I just bought that thing for the next 2 months for $1, what do I have? Well, I have a wing and a prayer. It's a wing and a prayer. That's when I go, oh, please go up, please go up, please go up. And if the stock goes up and goes up really big, okay, I'll start making money not at 110. I need 110 plus the $1. Now, do I ever have an intention of buying the stock at 110? No, I have the right to buy the stock at 110, but I don't have to buy the stock at 110. So why did I buy the call? Because I'm trying to make money off of it. But you got to think about this. We don't even know what stock this is other than it's stock, okay? You don't know what stock this is. But I want you to think about this from a probability standpoint. Okay? Probability standpoint. Is there a good chance that a stock runs all the way from 100 up to 110? It seems like a pretty monumental leap, doesn't it? Okay, it's a big leap of faith because to get to 110, that stock's got to move up by a tune of 10%. But you only had to pay $1 for it. So again, maybe it has a 10% chance of getting up there. That would be about it. Again, listen, it has to make a 10% move to the upside. It's a big move. And again, depends, of course, on the stock. So what happens if I didn't buy the 110 call? What happens if I went out, okay, and sold the 110 call? And instead of paying $1, I collect $1. Now, a lot of people that are brand new to this, they go, whoa, 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 stop. How can I sell something? I never owned anything. Options are rights and obligations. Buyers have rights, sellers have obligations. Buyers have rights, sellers have obligations. When you sell a 110 call, you're selling yourself into an obligation. Obligation to do what? To give somebody your stock at 110. Do you own stock? You're like, no. You're like, wait a second. So I'm obligated to give them stock at 110, but I don't even own the stock. Is that what you're telling me, Don? Yes, that's exactly what I'm telling you. But the nice thing is you collect $1. And when you collect that $1, you get to keep the $1. If the stock stays flat, you keep $1. If the stock goes down, you keep $1. Even if the stock goes up, you'll probably wet yourself. But as long as the stock is under 110, you'll be okay. What happens in the bad times? What happens if the stock goes from 100 and goes all the way to 120? I'll tell you what happens. You get sick and vomit. Because what? The stock went up $20. You have to give somebody stock at 110. How do you give them stock at 110? You buy it at 120 to deliver it to them at 110. How's that work for you? Well, then you lose $10. Of which, though, you collected $1 up front, but you get what I'm saying over here. That could be extraordinary amounts of risk. Well, the logic, though, of selling the premium is a very simple one. We're selling, again, this 110 call, and we're selling it to collect the $1. But then we're simultaneously buying, we'll give you an example, of a 115 call. And maybe I have to pay a whopping, we'll just put it at 50 cents. So net, what do I collect on this thing? I only collect like a whopping 50 cents. You're like, what? Yeah, you collect 50 cents on here. Can you lose money? Of course you can lose money. You lose money on this. How much money can you lose? Well, you are basically short stock at 110, but you have the right to buy the stock at 115. So what can you lose? The maximum you can lose is the distance between the strikes. These are called strikes, the 110 and the 115. So what's the most you can lose? You can lose $5, of which you already collected 50 cents up front. So your definitive out-of-pocket risk is $4.50. You know how to figure out probability in this? Just take the $4.50, divide it by $5. What do you got? You got probability right there. You're like, what? It's chaos, I tell you. Chaos. Okay? Think about that for a second. That's actually one of the cheesy yet very effective methodologies, okay, for calculating probability in trading. So what's the probability of this? That'd be the equivalent of a 90% probability in this trade. If you want a 90% chance, you're going to be taking upwards of $4.50 a risk. That's how trading works. Okay? But here's the bottom line. This entire thing, all I want to show you right now, okay, just some easy premium selling logic. You can sell something that you never even owned, okay? And if the stock stays flat, you make money, okay? Is the stock going to go up or down? Sure, but there's a 50-50 chance whether it goes up or down. So if the stock goes down, you keep what? The 50 cents. If the stock stays flat, you keep your 50 cents. Even if the stock goes up, as long as the stock is below 110, you keep your 50 cents, okay? I like it. By the way, there's a great question that came in here. Can I sell my wife? Done. Sold. You can sell anything you want. Okay? Don't sell your spouse short. Why not? Sounds like a good plan to me. Anyway, continuing on. So all I wanted to do was just throw out the general logic of it. Right? Now, a little bit more in depth. We're going to go piece by piece, step by step. Selling out of the money options. Well, here. Now we're actually going to get into a very specific example. We're going to sell a 110 call for a $1.50 credit. Okay? If the stock expires below the short strike, you keep the credit. You get to keep the $1.50. But what's the risk in this? The risk in this, okay, is the stock cruises all the way up here to 150. And then what do? You're like, oh, you get sick. Okay. That's not good. That's not good for anybody. Right. So selling the option and selling it naked for some people might be right, but for most people, it's going to be an extraordinary amount of risk. And we don't want to put you at that kind of risk. So what do? We'll actually use a high probability credit spread. Now, I'm going to take this a couple of steps further here momentarily. So don't get all caught up. Okay. All I want you to do at this point, and again, I'll reiterate this time and again, just grab big pieces of logic. Okay. Don't get all caught up in every little nuance over here. Big pieces of logic. Now, we're going to sell a 110 call for $1.50. We're going to buy the 115 call for 50 cents. Okay. Net, what do you actually make on this trade? So let's net it out and figure it out. Okay. So the net credit, well, basically is $1. What's the probability in the trade? The probability in the trade, how wide is this spread? It's a $5 wide spread. What's the most you can lose in a $5 wide spread? We could lose $5, of which you already collected $1 up front. So your definitive out-of-pocket risk is $4. How do you figure out probability? Just to figure out the $4 divided by the width of the spread. What's the probability in here? Okay, 80+%. So let's take it a little bit of a step further now. Are we having fun yet? Okay, because why just sell, okay, out of the money calls? Why not additionally sell out of the money puts? So if we're selling a 110 call, couldn't we also sell a 90 put, right? Be equidistant. Let's be equidistant and then turn around and buy an 85 put, okay? And let's assume that this was done for a similar type credit. What's the net credit over here? Let's say you collect another $1, okay? Now what do you want to have happen? So we collected, okay, $1 over here. We collected $1 over here. What do? Now we're actually boxing the stock in. We're saying you can go up or you can go down. Just don't get crazy, because if the stock expires anywhere inside of this standard deviation, okay, you're actually going to make money on it. And that's, again, that's the logic behind selling premium. It's the logic behind selling premium. But is it effective? Now, got a question. How many people have actually gotten this far before? How many people have gone out? And all I'm doing right now is constructing what is termed an iron condor. Okay. So effectively what we're doing, I'm going to blank the screen. Okay. I'm going to blank the screen, and just all I'm doing is just selling out of the money options on either side of this. And I'm going to tell you the exact life cycle of most traders. Okay. Again, how many people have ever sold an iron condor? So a couple of people, maybe a few. Okay. So what I'm going to stress to you right now is this. The iron condor, it absolutely works. Okay. The first time you do it, it works. Okay. The second time you do it, it works. You know why it works? Because the trade itself may have upwards of like an 85% probability of success. Think about that for a second. If the trade has an, I don't care, let me has an 80% to like an 85% probability of success. So the first time you do it, it makes money. The second time you do it, it makes money. The third time you do it, it makes money. By the fourth time you do this trade, you're not doing one contract anymore, are you? See, you started the trade, and when you started the trade, you were trading one contract in the SPY. By the fourth trade, you're trading like 10 contracts, and now you're trading in the SPX, which is the mother of all products. By the way, the market is really, really smart. It lets you actually make money 4 times, and on the 5th time, you know what it does? Wham! Absolutely wipes you out, but it waits. It waits to wipe you out because it waits for you to do 10 contracts, and it waits for you to do 10 contracts in the SPX. It is evil. It is an entity all-knowing and all-seeing. If you don't believe that, I'm telling you right now, you have never done this trade, because I've watched this thing for 15 years at a brokerage firm, and I've watched so many people go through this life cycle. I sell one, I sell one, I sell one, I sell one. I get absolutely killed. You think I'm new? I ain't new. Okay. How many times do you have to watch the exact same thing to realize you're like, oh, I know how this movie ends. It ends with you getting absolutely killed in an iron condor all in one day. And it's actually what we call, okay, the 80% probability and the 20% hammer. 80% trades, they sound great. But 20% of the time, the market's going to rip your face off. When you trade high probability strategies and you're wrong, you're going to get hammered. And again, the market's just evil enough to allow you, to lure you in. You make money 3, 4, maybe 5 times. You increase contract size. And then, of course, it's the train wreck. And your losses are going to exceed the gains of the previous 3 to 5 trades. Okay? Again, if you've ever been through that life cycle, again, oh, I know. It's like I could see your account. I could see your account. How do you think I learned this stuff? We sit there, watch order flow. By the way, at TD Ameritrade, we would study you. What does that mean? We would actually study everything that people did inside their accounts. Why? Well, I ran the education division of TD Ameritrade. And you wouldn't be very good at your job if you didn't study what people did right and what people did wrong. Okay? And I'm going to tell you a couple things they did wrong, and then I'll tell you what goes right. I can fix it. I know I can fix it. Fix is a really dirty word. The people call it fix. Okay? But anytime you're fixing a trade, you're just adding more risk to an already losing trade and racking up transaction costs. What's one of the first things you learn in this business? You learn, don't add to a losing trade. Don't add to a losing trade. It's like one of the sins of the business. Don't add to a losing trade. Well, they don't call it a losing trade now. Now they call it fixing a trade. Because fixing a trade isn't losing. The only reason you'd fix a trade is because it is losing. Therefore, you are fixing a loser. You're racking up transaction costs and more risk. Okay? 15 years in the brokerage business. Okay? Totally a cynic on this one. Some fixes may work, but the very notion of fixing a trade, good capital after bad. I can't stress that enough. Yesterday's trash. Take a car, drive it off a cliff, and then bring it to the body shop. The body shop is going to tell you the same thing about the car that I'm going to say about your losing trade. It's a piece of crap. Let it go. Do it right. Learn how to correct good positions gone bad. Now, we're going to talk a little bit here, all right, about selling premium the right way. Some of you guys are like this. Some of you won't. Okay, bear with me over here because there's a lot that's going to go on this screen. All we do is we have a stock, okay? Now, this stock, it could be the spiders, or it could be, for those that are more experienced, the SPX, or it could be the Russell, or it could be, all right, the QQQ, or it could be something like Amazon, okay, or what? Goog. Any of these you could sell premium on. But selling premium, it's not what you think it is. Selling premium, okay, is about what we call inventory management. Nobody likes to hear that. But the only way to be able to make money on selling premium, okay, in these markets today is through inventory management. What that effectively means is this is where the stock happens to be. We're going to go out and we're going to sell some premium. We're going to sell here, buy here. We're going to sell here and buy here. Now, this is your mighty, what they call the iron condor, just like we did earlier, okay? You sell like a 110 call, then you turn around and you sell a 90 put, then you turn around and you buy, okay, a 115 call, all right, and buy an 85 put. But see, what a lot of people do when they sell premium, that's what they do. They just go out there and they go, okay. By the way, this is called an iron condor. Now, everybody in here can Google that. I always tell people that, oh, you can Google it. It'll tell you what an iron condor is. Knowing what an iron condor is will never, ever, ever make you money on an iron condor. You got to know exactly which strikes to sell, which strikes to buy, okay? But what it comes down to, the iron condor, it's a management-based strategy. As I was saying, what most people do is they put on the iron condor, okay? They just put one on, and then they do what? Then they pray, okay? Apparently, this is a strategy that involves heavy prayer. What's the prayer? The prayer is, okay, if the market goes up, you're like, oh, go down, go down. And then the market goes down too far. You're like, oh, no, go up, go up, go up. And all of a sudden, the market's up and down. This is like a totally schizophrenic trade. You're like, no, every move the market makes is the wrong move. Because if we go up, you panic. If we go down, you panic. Because you're short this and you're short this. And what happens? Okay, I'm going to tell you exactly what happens. This is the one where you make money, make money, make money. All of a sudden, all you need is what just happened in October. In October, the market went from here. You woke up like 2 days later, and it was down here. And what happened to you? I lost everything. Okay, what was your strategy to get out? And you go, You couldn't have gotten out because one of the days that we had that was a big down day, we opened down here. There was no time. If you were trading something like Apple had a little announcement and the stock went from here, blip, right back down. You trade something like Tesla, dead. Okay, even the S&Ps, they dropped fast. Okay, there was a 70-point drop. Okay, so I apologize, a 75-point drop in the afternoon when the market was closed last week. It was last Wednesday. The market was closed last Wednesday, of course, in observance of George Bush. And when the markets reopened on some news, 75 points were lost, okay, out of the S&Ps in 3 minutes. How are you going to get out of that? Market was closed. You go, I don't know, and I don't like it. Think about that for a second, okay? Is that the right way to sell premium? No, it is not. We actually teach us distribution of capital, okay? And what you'll effectively do is we're going to allocate several small positions. Why? So that all of our troops are not sitting in one spot at one time. We're spreading capital across a line. But there's a problem with this as well. First thing, if you do multiple trades, that's all well and good. But let's call these trades. What happens if these trades were all in the month of January? Options, what? Have expirations. If you do all the trades in the month of January and the market crashes in the month of January, all of your January trades are dead. So you're going to learn to trade in January. Then you're going to learn to allocate a bit to February, all the way out to March. If you're not in 3 expiration cycles simultaneously, you're dead. And it's actually layering capital in. Now, I'm actually going to show you what that kind of looks like in here. You're laying capital into other capital. So you've got an iron condor. Oh, my pen got big again. All right. You've got an iron condor. My, what a large dot you have. You have an iron condor. Okay. Let's call this one for January. Then the market rallies up. After the market rallies up, you layer in an iron condor for we'll call this expiration February. And maybe the market sells off a little bit, and then you layer in another one, and we're going to call this one March. And what you're actually doing is smoothing out your risk curve by distribution of capital. All right? You have to be in a minimum of 3 periods, a minimum of 3 periods. And you must scatter capital efficiently through those 3 periods. Now, it doesn't just stop there. To sell premium effectively, you're also going to have to create, what we term volatility hedges. So I can protect you to the upside. If the market's going to rally, even an explosive rally, remember, you sell these 110 calls. Remember those? If the market's going to rally all the way to 110, listen, even if it explodes higher, it's not that dangerous because the market exploding higher still gives you time, because volatility contracts. So as the market goes up, think about this. Market goes up, what goes down? Volatility goes down. So in a rallying market, you have plenty of time to bail out of these short calls. Most of the time, The big risk when you're selling premium is a fast and violent down move. The last time we had an extreme down move, obviously you could point to 2016, Here's a couple of big down moves, In recent history, August 24th of 2015, the market opened down 7%. It went limit down at the open. After that, it was February of 2016. February of 2016 was met with some extreme volatility. People got crushed to the downside. We also just had February. By the way, there were a couple incidents in 2016 because it was Brexit. There was the election night, and then we rallied back up. But February, obviously, of 2018 also blew up volatility traders. That was February 2nd through 4th, blew up volatility traders. All you needed is actually what we call, a vol hedge. If the market comes rushing down, we can actually teach you how to puff out this curve, meaning that you won't take losses on the downside. And the losses that you do take, if you take them, are going to be very, very minimal. There's a lot more, to selling premium. Again, there's a lot more to selling premium than just going out there and saying, all right, I'm just going to sell an iron condor. Every one of you can learn this stuff. And I'm going to tell you right now, you can't be a monkey out there throwing the dart. You're not going to be a good stock picker. Is there a good stock picker in this market right now? Legitimately. Unless you're short. What's a good stock right now? Come on, what are you going to do? Oh, I bought some GE. Okay. What's a good stock picker right now? You'd have to think that we're going to rally out, huge. But there haven't really been great performing stocks, and they're few and far between. Maybe you went out there and bought some utility stocks. But you think about the next few years, you're going to have to learn to strategically, sell some premium. And you're going to have to do this the right way. And I'm sorry, but there's a bit of a learning curve to this, and you're going to have to know some of this stuff. But don't fear the sale of premium. Maybe you have limited experience in options. Maybe you don't even know what an option is. Just don't let options intimidate you. Okay? You need these strategies. You need to know these strategies for the foreseeable future. I mean, you have to make a decision as to what you're going to do for the future of the marketplace. And a lot of people in here are literally going to sit there and they go, I'm just not going to do anything. You're going to watch your 401k diminish like it already has. Okay? We can show you how and when to place these trades in a matter of a few hours. What we do is create detailed recipes for every trading strategy, including selling premium. And people, you wouldn't bake a cake without a recipe. Why would you trade without one? So the logic we discussed is how firms in the street sell premium and minimize their collective risk. Firms actually go out there and they use a distribution of capital. Okay? This is what you need to know, though, to successfully sell options for a living. And that's what we really want to get to. What makes a viable premium selling candidate? What does that mean? Well, what volatility should I seek out? Okay, what options expiration do I select? What should be the delta of the options I sell? What should be the delta of the options you buy? What options do I sell against my position? That's an interesting one. How do I roll my options and manage the risk? What's the right amount of risk for me? Okay, what steps do I take during market rallies, sell-offs, or extreme bouts of volatility? I'll give you an idea over here. Here are some very recent premium selling examples. We've just started now to transition into premium selling here at TheoTrade. And we've just been probing into a couple of positions. I'm actually going to show you a few of them. This is premium selling trade examples. This is just a spider iron condor. And I want to show you, okay, here's the exact opening date, the closing date. Now, this thing isn't like, hitting a home run. We sold something for 88 cents. We bought it back for 34 cents. I don't know how many contracts. You do 10 contracts, do 100 contracts. By the way, if you do 100 contracts in the spiders, you might as well just do 10 contracts in the SPX. Anyway, we sold the thing for 88 cents. We bought it back for 34 cents. Okay? The exact time, date, everything. Is that recent enough for you? I just closed it, okay? What? A few days ago. I only wanted to put absolutely, bleeding edge recent trades in here. But to point this out, as I said a moment ago, even a monkey could figure out probably how to build the iron condor, right? Okay? But I stress to you, by the way, one person came in with one stock that's going up. That's all you got. What are you supposed to do? You're supposed to put your entire 401k into one stock. You're like, here we go, roll the dice. This thing is going to be beautiful. Okay? You can't go out and just sell one iron condor and expect results because you're going to get crushed. Remember, you have to allocate. The next iron condor. Here's another one of the spiders. Now, what's different in this one? Look, right? Camera 1, camera 2, camera 1, camera 2. The next iron condor that I'm actually showing you, well, this one's for a different expiration cycle. This one's actually for December. We sold this one for 91 cents. Okay, we bought it back for 68 cents. There's not that much profitability in this one. Okay, but I'll tell you what, this one got nerve-wracking. Okay, this, though, the entire iron condor, when I say this iron condor was only on for what? From the 10th of October, to the 28th of November. And it was in an extraordinarily volatile time. Did it eke out a gain? It did. But this iron condor was helping mitigate the risk of the previous iron condor. They're different strikes, different expirations. Now, to continue on with this one, I don't just leave it there. This is actually a volatility hedge. I wanted to show you what one looked like. Okay, this is actually a risk twist hedge. This one was actually put on in September, okay, September 20th. It was exited, all right, on October 11th. Remember I told you when you're actually going out there and you're managing risk, okay, if you're managing risk and here's your distribution curve and you've sold your iron condor, you need something out here. You need something to be a hedge. This is your volatility hedge. This is an RTS spread. We call it a risk twist spread. Okay, risk twist hedge in this particular case. Why is it a hedge? It's reducing risk of the iron condors. I had 2 iron condors on. We opened this thing for a $1.20 debit. It closed for $6.59. Why? The market sold off, okay, and the hedge exploded in value. Now that hedge, again, had it not been there, I'd have lost some money on some other iron condors. I would have lost some big money on some other iron condors had this hedge not been in play. Then I also additionally went out and I traded into the IWM. What's the IWM? It's the Russell. This one was put on for about a month. Put it on for $1.25 credit, closed it for a 70-cent debit. It's decent profitability in a very, very short window of opportunity in here. Again, all I'm trying to show you is, again, what? Just showed you 3 trades that are having effectiveness in a marketplace that's become extraordinarily volatile. Premium selling is starting to transition to be able to work. To do all this stuff, you need recipes. And that's what we do here at TheoTrade. It's criteria. Trading's all about answering what ifs. What's a good stock or ETF candidate? Clearly, you've seen the IWM and the spiders and the SPX, but you can also do this in equity products. How much capital do you commit? Which strike price options do you buy? Which strike price options do you sell? We have the answer to all these questions. Okay, that's what these checklists happen to be, and all the unique variables. Okay, what are variables? How, when, why, at what price? It's just the beginning of the variables that you're going to face when selling options premium for a living. And I always say the secret's in the sauce. You can read about the strategies anywhere, but the following strategies and the corresponding criteria, it's the utmost attention to detail. We spent years fine-tuning trade setups criteria. Okay, you got to follow steps to be able to build a trade. Here's how you can sell options premium for a living. The sell options premium for a living. We have a workshop coming up. It's this Saturday, December 15th. We're going to talk about the logic behind selling premium so you understand why these trades work right now. How to build an options inventory. Okay, so you spread your risk across products and time. Okay, a professional trader's guide to capital allocation so you know exactly what your risk is going to be at all times. You're actually going to learn a little bit about the Greeks. What are the Greeks? Okay, it's your lifeline to minimizing and understanding risk. Okay, the key to all traders is got to be risk management. That's what selling premium is about. It's about risk management. If you understand how to manage your risk, you're going to thrive in these markets. The class, as I said, it's coming up December 15th. It's going to be 4 to 4.5 hours. And, okay, when you enroll for the class, we're going to send you out what we kind of term some prerequisites. If you don't have enough time, obviously it's Wednesday and this class is coming up Saturday. First of all, the class is archived immediately and it has 24/7 access. We even have mobile access now. So there's a TheoTrade mobile trading application. You can even watch our classes now when you're not online. Archive classes can be downloaded on the mobile application and watched from, 50,000 feet. I don't think you're going to 50,000 feet unless you're flying privately, but they'll be watched from 30,000 feet. The entire course, okay, again, is taught this December 15th. And again, the class itself, which is the slide deck, will be ready for download on the morning of December 15th. The class also qualifies you for a reduced commission rate. We, here at TheoTrade now have deals in place with E-Trade, TD Ameritrade, and Tastyworks. The course is $297. We do, in fact, have a little bit of a special for you this evening on the course, and I think it's well worth your time to hear us out on this. Most of you kind of joining tonight, listen, we've been doing this a very long time. Most of you kind of think when it comes to courses, you kind of been there and done that. you're tuning in, you've been through the gauntlet of paid classes. You've been to this class, that class, you bought this indicator, that indicator. You even tried the secret squirrel black boxes. But then you got to, I did the class and they charged me more for an indicator. But wait, there's more. Then you have to take another class. And on top of that, before you know it, okay, listen, there was an education group that I ran at TD Ameritrade. They charged $24,000 for 18 months of education. $24,000, okay? What we do at TheoTrade absolutely, okay, categorically smokes what we did back then. Okay? Back then it was like all watered down and stuff. Forget all that garbage. $24,000 doesn't even hold a candle to what we do. Okay? We've had enough of educational garbage sales pitches and we intend to put an end to it. What we do now, well, let's just introduce it. Everybody here at TheoTrade has a minimum of 15 years. Okay? Experience. They're all professional traders, not professional salespeople. Educating you, it's our only goal. Well, how do we demonstrate that? We have what we call TotalTheo Unlimited Streaming Monthly Membership. What is it? Well, you get everything. What's everything? It's everything. It's $99 a month. Okay? It includes the upcoming course. So you enroll for $99 a month. Is it a membership? Yes, it's a membership. Can you cancel anytime? Yes, you can cancel anytime. How much is it? It's $99. Okay? You pay $99. You don't want to do it next month? We part on good terms. But in 1 month, how many classes can you watch? As many as you want. It's unlimited streaming. It's Netflix for traders. Oh, by the way, again, it includes the Saturday class, right? Includes it. You can stream the Saturday class live. You can stream the class, archived. But it also has access to over 78 other trading classes. They're all available immediately. By the way, I'll show you some of the other 78 classes, all on demand. There's new monthly classes. We're doing about 2 classes a month. What's also included? A live trading chat room. The chat room, we're broadcasting. What does broadcasting look like? You want to see what broadcasting looks like? Looks like this. Okay? This is a live class going on right here, right now. Okay? Live and uncut. What is it? Okay? Well, there's actually what they call a happy hour going on right now. What does the happy hour do? It makes us very, very happy. So it's a happy hour. So, it's actually playing right now in the background. I'm sorry. Anyway, yeah, we have our happy hour going on right now. So it's streaming, and you can see just how many clients are in there, everything. On top of that, and again, we broadcast 6 hours a day, but we also broadcast on a Wednesday afternoon. Okay, so on a Wednesday evening, we also do a little bit of a happy hour class. So there's also 59 proprietary indicators and scans. We don't sell you any additional scans and things. By the way, if you want to see it, there we go. Got it streaming a little bit now. Okay, so this is live. This is all going on in here. He's just wrapping up right now. But, and again, this is Corey Rosenblum. Okay, really like the part about, statistics, nice work on the stats, 3 Sigma moves. This is cool. I mean, again, this is live, and he's streaming his screen. This is exactly where the class is going to take place. We email out trade ideas. We have now 4 portfolios. You can actually take a look at some of our portfolios. Whatever the portfolios look like. Here, you want to see what they look like? Okay, so the portfolios. We have a duration portfolio, a fruit fly portfolio, a growth portfolio, and a sell premium portfolio. Yes, there's a sell premium portfolio. Did you know that all the trades that I just showed you guys a little while ago, every one of those trades was emailed out to our clients. Every one of the trades that made money was emailed out to the clients. Okay? Daily coaching sessions with timely topics. Instructors will all answer your questions via email. We answer emails. TheoTrade.com/all. Now, kind of what our members are saying, and I love this because I always like to read this one specifically, and it's because it's really refreshing that you guys have put this together, sharing knowledge and not upselling everything and turning and burning your customer base. Got a customer for life, okay, in me because of this approach. By the way, right now, we're just shy of 3,000 members on TheoTrade, okay? You can take the course, Selling Options Premium for a Living, or you can actually join the unlimited streaming. If you just want to take the course, it's a one-time fee of $297. If you want the unlimited streaming, by the way, the unlimited streaming includes the course, Selling Options Premium for a Living. It also includes 78 other classes, new monthly classes, live trading room, email trade ideas. Everything's archived. It gives you access, of course, to the mobile application, trading indicators and coaching sessions, you name it. Why do we do this? Okay. Why do we do it for $99 a month? Okay. We would rather you sign up for $99 a month than $297. Why? because we know you guys are going to love this. We know you're going to love it so much, okay, that we're pretty much giving you $200. I would take the money. I'd pay the $99 a month and just go for it. Again, some people don't like, memberships. I got it. It's a membership, okay, and it's worth it. Again, TheoTrade.com/all. Let me actually show you a little bit about the site, and then we'll get you guys enrolled for this, answer a couple of questions over here. So I can't stress to you enough. Again, I've actually taught classes over the years that were $5,000 for 2 days with us. And some of you guys probably remember those classes. I started going out and teaching a few classes even before thinkorswim. We charged $5,000 for 2 days. The stuff that we do now at TheoTrade, it'll smoke it. It's $99 a month. Why can we do that? Because we have 3,000 members. That, and we have TD Ameritrade and E-Trade and Tastyworks, okay, helping finance us. They want our clientele. They give us also commission discounts. It's a good deal. This is actually this is the TheoTrade. This is the paid members site. Okay. So these are all clients, and we're kind of scrolling through. So that's the actual chat room where you get to discuss. This is where we stream video. What else do we have? You're brand new. We have a whole start here menu. What's a start here menu? Options 101. Okay. Options 102. Options. Okay. 301. Then we have order execution. This is all classes to prep you, okay, to understand and get you on par with what everybody else already knows. So we want to get everybody kind of ramped up in the same way. So we go through 101, 201, and they're, again, multi-part sessions, right? Does it look like a lot? Yeah. But for $99 a month, we'd rather overwhelm you rather than underwhelm you. And the cool thing is, okay, have at it. If you don't know where to go, we can even give you like different tracks. We can say, what do you want to be when you grow up? What kind of trader do you want to be when you grow up? You guys tell me right now. Do you want to trade options? Good. Here's option strategy classes. Here's option newbie classes. You want to learn technical analysis? Okay. We are unrivaled in any of these classes. Technical analysis. Come on. We have Jeff Bierman. We have Corey Rosenblum. We have Slim Miller on the crew. Okay. You want to know about Fibonacci's? Awesome. We got a class for that. Technical Analysis 101, Contrarian Trading, the Art and Science of Trend Trading, okay, Volatility Indicators and Oscillators class, you name it, it's actually in here. Day trading classes, stock classes, futures classes, hedging strategies, trend trading. We even have mindset, okay, classes. This is to actually get your head in the game. By the way, there is a class right here, 5 Essential Building Blocks to Successful Trading. Okay, when we first sold that class, it was $1,000 for this class. Literally was $1,000. Now we just stream it for $99. Why? Because we can. We have enough members to be able to do that. This is the actual member home. Everything is a full searchable. We can basically, this is like the Google, but for just TheoTrade. So you can come in here and you can type in anything you want, like expiration risk, expected move iron, earnings, here, expiration risk, and hit search. And it'll actually give you every single archive. Okay, coaching session, expiration risk and position analysis, expiration and pin risks. You name it, there's an archive for it. Continuing on, here's where I actually enroll. How do you enroll? Just come right here. It's TheoTrade.com/all. Okay, TheoTrade, again, been around. This is now our 3rd year. Listen, we left TD Ameritrade to launch TheoTrade. Okay, this is a crew that's highly experienced. We ain't new. Some of you guys aren't either. We'll be here to support you the entire way. Again, you can email us questions. It's only $99 a month. Let me answer a couple of the questions for you. First one that always comes up is somebody says, is it a membership? Yes, it's a membership. Can I cancel anytime? Yes. There's no minimum monthly. Okay. If you sign up for $99 and you're like, this is just not for me. I get it. We'll still part friends. Right? We get that. You know what the funny thing is, though, about TheoTrade? People will sign up for $99 and then they'll get busy one month and they're like, leave. They always come back. Like, that should actually be our slogan, okay? Because you can go to any education firm out there. Bar none, you ain't going to find anything anywhere near what we do here. There's nothing even close to what we do here. That's what we enjoy. That's kind of what gets us up in the morning. Look how many courses are in here. Okay, you want to learn about covered calls? Done. The next big short risk twist spreads? Gotcha. You want to learn about RSI, Laguerre? Got that too. Fractal energy courses, technical analysis, plan to get slaughtered, the whale trading workshop. It's all in the archive, and it's all $99. If you ever need to get a hold of us, support at TheoTrade.com. We're there right now. Okay, we're here. You want to leave a message? You don't have to leave a message because we're live right now. You can actually chat with us. If you've got questions, you could also call us if you've got questions. It's TheoTrade.com/all. If you can't get approved for options, we can help you get approved for options. Every strategy that we talk about here at TheoTrade can be done inside of an IRA. I trade now inside of my IRA. Day trading margin rule, we can help you circumnavigate that if that's going to be an issue. Of course, not only is the class recorded, everything we do here at TheoTrade is recorded. Okay, everything we do. If you don't have a lot of time to be able to trade, that's fine. First of all, again, everything's archived. Number two, we will email you out the trades. We even have a portfolio that's for people that can't sit there all day long. What's the name of the portfolio? It's called duration. Take a look. There's the duration portfolio. There's a fruit fly portfolio. The duration portfolio, I can't sit in front of my screen. Do you realize that there's firms out there, they'll charge you $99 per portfolio. That's all included at TheoTrade. Corey's Corner, different resources in here. Okay, you can even have links to the different brokerage firms. We also have daily news articles that come out in our Theo Dark Report. Okay, it never stops. And we continue to add stuff. Why? Because we can and we enjoy it. All right, we built TheoTrade on a very similar model to what they do over at Netflix. What's that? Just keep adding spectacular instructors and so forth and never look back. With that, again, I want to thank everybody for tuning in tonight. I think I got almost all of the questions out here. And again, it's unbeatable instruction, okay? And for $99, an unbeatable price. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Hopefully I'll see you not only on Saturday, but you can tune right in tomorrow morning. I will kick off tomorrow morning, which of course is Thursday, right at 8:22 a.m. Central Time. 8 minutes before the cash open, we kick off every morning right here at TheoTrade in the TheoTrade chat room. Also, see you guys on Saturday. Thanks everybody. Have a good night. Bye-bye.